Hello, guys. This is Julie. Good afternoon. Good morning. I want to take a quick look at some of the price action, talk about our setups for next week, how to think about maybe selling some premium, and see how the implied volatility levels that the option traders are using coincide with the Jats PT levels, which is the real volatility levels um, for historical volatility. And these statistical levels are often used in the market as precise locations for the market makers to come in and move the market. Um, and once you get used to the bell curve, that if you break the one, you're usually going to the two and the three on these distributions. So one, two, three. And just following this flow, whether it's going long or short, it will go up and down, up and down, up and down. Very difficult to have like a quote trend trading strategy unless you back your time frame out significantly and approach the market from a weekly, monthly kind of viewpoint. Then you can get inside of a you know more of a protracted range. But these ranges are very volatile during the month. They can be very flat during the first couple of weeks, going into that third week of OPEX and expiration. Then the volatility will kick up. However, we're in uncharted waters here with the Fed tightening into inflation and saying that they're going to the markets are going to experience some pain. He said it twice. The pain word came out in two times. So not boding well, especially Friday with price crossing above the weekly one. So it's going in the middle between the two, which is good because their premium is cheaper inside the middle. But then it started breaking it and moved down to the three. The traders brought it back inside the two lower ones, and these are the calculations off the close and the open. The open is below the close this time, and brought it closed above it. Again, bringing it back inside the middle of the weekly distribution. So everyone was getting, a little bullish for, obvious reasons. And the Globex 1 came into play and they slammed it down off of that level. Would, put the breakers on. That's the pins. Would not let it continue going higher despite several tries, and it failed. Some news came out, serendipitously timed news, I say, to get the market back in the direction of their uh, calls. If they're selling calls, this is exactly what you would expect to see. So a little bit of a shakeout above the one, a little bit of pain in the market, as he said, and then sent it back down. So that's why I think it's bearish. But anything can happen going into next week. Like I said, we've got an abbreviated trading session Monday with the holiday, regular open on Sunday on light volume, and close early on Monday, noon and 1:30, equities, energy. And then we go into a Tuesday with CPI that's seasonally adjusted, I might add, meaning all of their machinations come out in August, right? They can actually show a beat, you know, and the way that they mix their statistical analysis through both data and surveys, it's crazy. So it's very difficult to understand exactly what they're doing, and I think that could be, by design. But we'll get that as seasonally adjusted number, and so it could flip around, especially if we start, you know, getting into these quarterly threes. Normally, the market is supported at these quarterly threes. Um, If you notice the silver lines on the chart and the orange lines, I've marked up the chart ahead of time for us of the implied volatility levels at the CME that they have for their options. And I will show you how to do that with the option calculator in just a second. But instead of the option levels, you see that the market actually goes to the real volatility levels. And I see it time and time and time again. Um, the three is defended um, most all of the time, the quarterly three, um, or it goes to the lower of either the quarterly or the monthly three, whichever is the lower of the two contracts. So right now that level is 33.2775, and that is where I would put my red line in the sand and change that to red and make it thicker. There we go. So that is my line in the sand, taking it back to the September, October, November mid band um, of 2020. So realizing if that sells off, then it can start getting down to the bottom of that range easily. At 31.80, um, maybe 31.34. Here's a ledge that they bounced off of and held two tests. So 1, 2, 3, little ledge at 31.30. Here's the one quarterly one that they bounced off of. So this quarterly one looks even better. 30.75, 30.71. So I'm going to put another horizontal line there. Back. What I can do is I can just copy this one. 30.50. All right, so there is my line in the sands for the current contract. And I would certainly expect this first quarterly one to hold, first touch, if it even got down there. So, and maybe trade down to that second ledge for the downside move. But we are in the seasonality. We are also sitting on high volume for the ES. So let me show you that. Go to the Quick Strike website and you can see my high volume for the contract 39.2450, and that is precisely where we are sitting at the close and where that uh, monthly mean is 39.24. So we're sitting on the mean and high volume and going into who knows what's going to happen Sunday, but I know that we're at high volume. So high volume and the mean. So it's 0 to infinity, right? Going into 3 weeks of volatility. Um, so just trade up and down your levels. Here, let's go through the charts so that we can get a better picture. Here's the weekly, and the implied volatility levels are supporting the market between 40.45 and 40.25, maybe 40.89.50, 40.90, and an upper one way up there at 41.91. Sort of spread out. But this first grouping, maybe 40.50, would be your test of that call. 40.87.50. And this is a quarterly one right here that this intersects with, or is this sorry, weekly one? So there's a correlation right there. So I would say that this 40.91 level is pretty good. 40.90. Here's the daily. You can see we're near the edge. Um, and again, just like the other higher time frames, the market keeps it inside more often than not. That's why they are able to sell their premium so successfully, and it's so lucrative to do so, is because they normally will stay within a normal distribution. You can just open your eyes and see the puts are very well covered. When it challenges the bottom, that's the time that the Renaissance and the Citadels and everybody are jumping in. It can break, of course, but it is more rare to break than not. And if it does break, it's likely to break to the upside. If you're selling puts, you don't really care that it breaks to the upside. But if we're in a bear market, which I think we are, then they're going to be selling the calls. So when it reverses back up, that's when they sell it back down. And I've been noticing there's certain levels that they like to trade it to. Um, and that is the Globex one. I mean, it is oops, wrong arrow right there. See, over and over and over. Um, they like to go to their favorite spots. This failed. They tried to sell it and then whipped them back up to the 3 and then rolled it over. Very cool. But here came up to the 1 that held. Sold the bottom one. So they love the Globex numbers and they like the daily open as well. Um, I've noticed that was a nice spike into the 1. So just depends on where you are on these distributions, where you can get your biggest bang for your buck. Realizing that they will go into high volume. So you look for your high open interest and volume, and there's a heat map that we can look at and find out where the puts and calls are and go look at them on the chart. So what is amazing right off the bat are all these lower numbers starting to heat up with contracts. Um, which is scary when you think about it. If they're not going to hold the market up and something happened, it could just, everybody could be picking up the phone and say, you know, sell. That's what that is about. Otherwise, you have circuit breakers sitting in front of it. So there's a 16,000 put. So that's the high put at 3,000. And here is a 20,000 put at 3,300. And a 21,000 put at 3,500. So 3,500, 3,300 are circuit breakers. going to make this silver and solid and 3. Okay, so there's 3,500 and 3,300. And get back over here, and 3,600 is the put for 30,000. So that's your really big number. 36, 38, 39. All right, that's enough. I think we can survive with those. Um, and coming back up. That's about it. So, got the charts marked up, ready to go into next week, and have an idea of implied volatility of where to sell premium at. Um, if I wanted, to have a bearish sentiment, I would probably be looking at that 4,100 call. So if I wanted to go to the CME website, I could go to the option calculator and try putting a weekly, and then go down to that weekly. If I can find it. 4,100 call. And get $3,928 for the week. Selling a 4,100 call. And that's if I was bearish. If I'm bullish, then I could consider selling this. Oops. 38.50. So that's, taking a leap of faith into the bureaucracy and saying they are going to come to their senses and say, we made a mistake, we're not going to do it, the market's done it for us, never mind. So you could get another $1,000 by selling a call put at 38.25. and that's for next week. Now, what you would do if it, the your so that would be about $8,000 for next week and premium. What you could do is if it challenged it, if it got down here and you thought that it was, clearly, they came to the microphone, they said, we're hiking all the way up to, 10, then you can take this off before you get challenged. You don't even have to take any heat. You can just close it before it reaches the level, set a stop above it to close it automatically, and then you can adjust either by moving it out further and reselling premium, or the prudent thing would be to sell the opposite. You would sell a call against it. So you go and sell a call against that level as it's going down. So that would be the plan. And between the option levels and my levels, and seeing that the market pretty much goes to the um, real volatility levels quite frequently and makes these changes between the two, you could probably construct a pretty good trade plan about where to come in and um, engage the market, and or make an adjustment if your level is challenged, and so that you're not ever losing a trade. You can close it and make an adjustment and resell it. You can sell, buy or sell a futures contract to hedge it. There's many different things. So, say you thought that it might just come down and do a pop and drop or drop and pop, you could sell a futures going from the 2 to the 3. Um, you know what I'm saying? And hedge that option so that you didn't have to make the adjustment and sit through a little bit of a drawdown. Many different ways to do this. So, looking forward to it. I've got a private Twitter now. If you can't afford the indicator or don't have NinjaTrader 8, you can go to the private Twitter and get these levels posted daily for the markets, and always be on the right side of that spread whenever possible. See where the market turns on real volatility versus implied volatility. Oh, did I, I'm getting so old in my age. To make your selections, the contract will, when you select your expiry, will automatically put you uh, in a position away from the mean. So all you have to do is go one out, two out, or three out, however far you want to trade. Maybe you see that 4100 is sitting right there. You would rather go with the high volume versus the odd 4090. So you could recalculate your call in that instance and see the difference. 817 versus the 955. But you may, have a better chance with this not carrying any of that heat, because definitely it would go a little bit of a drawdown there. Um, so anyway, you know what I'm saying? You have the flexibility of, wiggling this around, and also by using the real volatility levels as your failsafe, because these standard deviation levels is what um, really is the anchor many times if it's going to hold. So when you had a confluence here of this lower mean and this standard deviation, where it popped back up after it came in and tested this low, um, stayed right back in the middle of the mean of your weekly. So they know where they're putting these contracts. I mean, there is a method for them trading to these locations. And once you start figuring out that they are, very simply going to their monthly means or weekly means, um, and going away and from them, and you can use the gamma and vega on your pricing sheet. Do I have a pricing sheet open? Let's put one up. So we're going into the quarterly, so I'll leave it on the quarterly expiration. So change it to Black Shoals on the settlement and give myself some more contracts. So here's where we're sitting right in the middle of the mean right now, 39.25. Here's your at the money, in the money flip on the call and on the put. So I would, be looking at that 38.20, 38.15 on the downside and the 40.20, 40.15 to the upside. High gamma is at 232. So that's 39.65 through 39.50. And so that's up here. High gamma. There we go. High gamma. So if it's moving higher, it likely is trying to get to that high gamma right here. Go into it. And then see which way it breaks once it gets inside the high gamma, whether it's going to break long or short. Okay, and then just, take it from there, go with the flow. Don't, try to sell strength. We are used to selling our edges, but sometimes when there's strength behind it, that's when you want to just keep going with it. Know where you are on the volatility threshold, and I'll post some of those PT2 um, slopes for us so that we know whether we're going in or out of the range. Um, Range expansion, you can definitely see the downward move, and then when it starts contracting, you see that bottoming process or flattening, or it can go long. As range contracts, it can go long. And though buyer beware, it can go short now on a downward um, move as well in a bear market. That is so frustrating. I wish they would get it right. But lately, a couple of times I've seen it go short. In fact, right here, it drifted short. This section right here into the support on short vol. Doesn't happen a lot, but it does happen. So just be aware of which way your volatility is moving, where your threshold level is. Volatility has a threshold just like everything else. So when you get to the end of your volatility range, know where that is. Capiche? And know that you're in outside of your normal range. Inside your normal range, you can have a low, medium, high. That's the way I do it. I want to know if I'm under or above that, going long or short. And am I, going to which standard deviation level that is next to an implied volatility level would be a very high probability targets to trade to. And we've got a couple of them. The main one is this top one, a weekly level on theirs, IV right on the line. So it doesn't happen a lot. I caught one of Infinitus's last week on the Globex, and you know, just when they happen, it's like it's fantastic. So you gotta really pay attention to the level when that confluence happens because it's very strong. All right, guys. I hope this helped you understand how to sell volatility. You can put straddles together. You can put, just sell your premium outright or use it as to buy premium. Premium. It's the same thing. It's either you're getting the money or you're paying the money. Um, and y'all have a great weekend. We'll get ready for Sunday close and have charts set up in the private Twitter. Thank you.